In this video, we're going to talk about share repurchases. A share repurchase refers to when a corporation buys back their own shares from their shareholders. There's many reasons a corporation might do this. A couple of reasons include a corporation may wish to support their share price in the market by buying back their shares, thus reducing the overall supply of shares in the market, which leads to another reason a company might choose to buy back their own shares. Supporting the share price in the market is a way of providing a benefit or value to the shareholder without triggering a taxable event for the shareholder. Doing something that increases the per share market value for each shareholder is great. The shareholder can choose to sell their shares if they want to realize some of that gain, in which case only then would the shareholder have to pay taxes, or the shareholder could just continue to hold the shares and not have any taxable event at all. Accounting for share repurchases requires us to know what the average issue price per share was. This is because we have to de-recognize the shares that are repurchased from the balance sheet. And the only way to do that is to know at what price were they put onto the balance sheet in the first place. That way we could take it off by debiting the appropriate account, common shares or preferred shares, depends on what's being bought back. Accounting standards prevent corporations from recognizing a gain or loss on the repurchase of their own shares. There's just too much potential for manipulation of the financial statements, the income statement, if a gain or loss was allowed to be recognized. So instead, if a corporation manages to buy back their shares for less than the average issue price, we have to deal with a new account. It's called contributed surplus. Contributed surplus is a shareholder's equity account, and it's a contributed capital account. Let's take a look at an example where we deal with some of these issues. This is example 14-2. The background is of the shareholder's equity section of 14-2 as of December 20XX, and we are given the following information. Shareholders' equity is broken out into contributed capital and retained earnings, as we would expect. And we are showing here that common shares have 1 million shares authorized, 10,000 issued and outstanding for $250,000. Retained earnings sits at $50,000 for total shareholders' equity of $300,000. The required asks us to record the journal entries, if any, for each item described below in 20XY. That would be the following fiscal year. Let's take a look at the first transaction we're asked to deal with. Repurchased 1,000 shares for $25 a share. I've got a note off here to the right. The repurchase price is equal to the average issue price. And what I mean by that, if I can add something up at the top here, we know that we have $250,000 recognized on the balance sheet with respect to common shares issued and outstanding. And the number of common shares issued and outstanding is 10,000. If we do the math, we see that we get $25 is what the shares were issued at on average. So now we know what the average issue price is. The journal entry to record this transaction, because common shares are being bought back, that's what we'll remove from the balance sheet, so we can debit common shares for 1,000 multiplied by the $25 average price per share that they were initially recognized at. That's $25,000, and a credit to cash for the same amount. Now notice that the cash amount just happens to be the same. Another thing that we are ignoring in this transaction are any sort of brokerage fees, just for the sake of simplicity. The question does not ask us to restate this section of the balance sheet, the shareholders' equity section, but let's do so anyway, just to keep track. Again, shareholders' equity is broken down into contributed capital and retained earnings. The common shares are still the same number authorized at 1 million, but whereas we previously had 10,000 issued and outstanding, that number should be reduced. It should now be 9,000. It's reduced by 1,000 shares. The dollar amount should also be reduced. It was previously 250,000. Reducing that by 25,000 brings us to 225,000. Retained earnings was untouched, and so total shareholders' equity has decreased by $25,000. Moving on to May 1st. On May 1st, they repurchased 1,000 shares at $20 a share. And again, I have a note off to the right. The repurchase price is now less than the average issue price. You'll recall from before that the average issue price was $25 a share. $20 is certainly less than that. What we do is we debit common shares for the amount that we are derecognizing. So 1,000 shares are being removed, and those shares were initially put on the balance sheet at an average of $25. So we should remove it for the same amount. We know that the cash that was paid, $1,000 shares, were bought back at an average of $20 a share. And we can see from what I have on the screen so far that this journal entry does not balance. We have $25,000 in debits and only $20,000 in credits. The missing piece is what we discussed earlier. A corporation cannot recognize a gain or loss on the buying and selling of their own shares. In an instance like this, where the repurchase price of $20 is less than the average issue price of $25, we need to recognize something called a contributed surplus. And in this case, it would be for the difference. Another way to calculate that would be as follows. We know that we had $25 a share as the average issue price. $20 a share is what they were actually bought back for, and we're talking about 1,000 shares. That would equal 5,000. Again, even though we weren't asked to, let's take a look at the shareholders' equity section of the balance sheet. Shareholders' equity is once again broken out into contributed capital and retained earnings. We have a contributed capital with respect to the common shares. The same number is still authorized, but instead of 9,000, we now have 8,000 issued and outstanding. And this is because 1,000 were just bought back. Previously, we had 225,000. Reducing this by a further 25,000 now brings us to 200,000. We have a new shareholders' equity account under contributed capital called contributed surplus. That's listed here, and it's $5,000. Retained earnings remains untouched, and so we have total shareholders' equity of $255,000. Our final transaction in this example is a repurchasing of 1,000 shares at $35 a share. Over to the right, I note that this is when the repurchase price is greater than the average issue price. Let's work out what to do. We'll debit common shares, 1,000 shares being bought back and canceled, and they were initially recognized at $25 a share. That was the average issue price. Again, maybe it's worthwhile just proving that. Let's scroll up to the top. Prior to this transaction on June 1st, our shareholders' equity looked as follows. We can take 200,000 and divide that by the 8,000 that are currently outstanding at the time, and we get $25. The only time that the average issue price is really going to change is when we issue more shares for a different price. Because that hasn't happened at all in this example, the average issue price is remaining the same at $25 a share. Let's go back to the example. So hopefully that explains why on June 1st we'll debit common shares once again for 25,000. 1,000 multiplied by the average issue price, which hasn't changed because we haven't issued any more shares at a different price. We know that some cash was involved in this transaction. 1,000 shares were bought back at $35 a share. Ignoring any brokerage costs, the total cash paid out in this transaction is $35,000. There is a $10,000 difference here. Where does that go? Where do we draw down on from? The first thing that we draw down is contributed surplus. Contributed surplus sits at $5,000. We can debit that for the entire amount. But you'll notice we still have only $30,000 in debits compared to $35,000 in credits. This entry still isn't working, and that's because we have to take the rest from somewhere, and that would be retained earnings. If the corporation were allowed to recognize a loss on the income statement, it would eventually end up in retained earnings. This is just doing it directly, so the income statement is not manipulated in any way. Now let's take a look at what the shareholders' equity section of the balance sheet is going to look like. Once again, shareholders' equity is broken down into contributed capital and retained earnings. Under contributed capital, we have our common shares with the same number authorized. That has not been impacted at all in this example, but we have 1,000 less issued and outstanding. Previously, it was at 200,000. We've reduced it by 25,000, and that's how we arrive at 175,000. Contributed surplus was at $5,000 here. That has been reduced entirely, and so really doesn't even need to be on this section of the balance sheet anymore. Retained earnings was at 50,000, has been reduced by 5,000, so now sits on the balance sheet for $45,000. Total shareholders' equity is $220,000. I hope you found that example helpful. So thanks for watching, and I'll see you next time.